Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm Paul Peebles, National Underwriter at Old Capital. With me today is Michael Becker, Senior Director at Old Capital.
Hey, Paul.
Hey, Mike. We are excited today to have Nick Fluellen in the studio. Everybody's been asking about Nick when he's going to come on. Nick is, not only does he own 1,000 plus units here in Texas, but he also sells apartments. So he is a broker with Marcus & Millichap, probably one of the preeminent brokers in Texas. We're excited to have him come on the podcast. Mike, people come up to me all the time and says, Paul, how do I get into property? I need some help on financing. One of the themes I wanted to kind of talk a little bit about today was the bank is your partner. The bank is your partner. Mike, if you can do me a favor, expand on that a little bit. Let's talk a little bit about the bank is your partner philosophy.
Yeah, when you really start thinking about it, when you're out there trying to purchase an apartment complex or any property really for that, and you're looking to get a loan, the bank's going to put in somewhere between 70 and 75% typically of the money, and you're putting in 25 or 30% of the money. So really, they're the biggest partner in this deal. Being a former banker myself, a long time ago, an old wise banker once told me, not to take investors' risk for lenders' reward. So what he was really meaning was, we're, as a bank, their upside really is, they hope to get all their money back plus interest rate of 4 or 5% today, where, you as the owner of the property, you can, significantly outpace that return on your money. So the bank's got to be pretty secure when they're out there loaning money. So when you're really thinking about it, what the bank's looking for is, confidence in you, that you know what you're doing, and that you have a plan to go in and buy this property and, either improve it or maintain the current good operations that are in place. So when we're putting deals together, we really have to have our clients, be organized, make sure we understand the financial statements on the property, the financial statements of the borrower, the operator of the deal, and this kind of what's the plan and how we're going to get there. And, Nick's really, like Paul alluded to, one of the most preeminent brokers in all the state of Texas, and Nick sells a lot of multifamily properties as well as owning quite a few. And in today's interview, I think Nick does a pretty good job of explaining what's going on in the marketplace and what it's like to operate an apartment complex and what it's like to interact with a multifamily broker to kind of help increase the chance of success. So I think without much further ado, we should just throw it over to today's interview with Nick Fluellen.
Welcome to the Old Capital Podcast. I'm Paul Peebles. Today, joining us in the studio is Mike Becker. Say hello, Mike.
Hello.
And Nick Fluellen. And so we are happy to have Nick join us. Nick is a little bit of an anomaly. Not only does he own multifamily properties, he owns about 509 units, but also he sells multifamily properties. And so welcome to the podcast, Nick Fluellen.
Thank you for having me today.
Thanks, Nick. So let's kind of introduce everybody to Nick. Nick, tell us a little bit about yourself. What's a little bit about your background? Of course, I think everybody knows that Nick went to Texas A&M University. He's a ring knocker, so very proud of that ring. So tell us a little bit about Nick Fluellen.
Well, I was born and raised here in the Dallas area. As you mentioned, went to Texas A&M University. And I've been at Marcus & Millichap brokering apartments since 2004. Started looking at partnering with some clients of mine to buy some deals in 2008. And so bought our first deal in 2008 and kind of continued to do that here and there ever since that time.
So let's have a little bit, maybe two parts of this conversation. First part, let's talk about a little bit about brokerage of transactions these days. And then second part, let's talk a little bit about your experience about you owning apartments here in Texas. So first part of apartments, tell me a little bit about your take on the apartment industry today. I mean, why do you like apartments? And let's talk a little bit more about the big picture of Texas.
Yeah, well, coming out of grad school at A&M, I knew I wanted to enter into the brokerage field, but I really wasn't sure really what sector to focus on. I had an opportunity to work with a very high-profile industrial broker, and then had an opportunity to work with a retail guy and an opportunity to work with a multifamily guy. And I think, like a lot of people, there's just an inherent value in having a roof over your head, and with the highs and lows of the economy, multifamily just seemed like a real safe and good place to be. And I just felt like it would be stable and just had a certain appeal. I think most people have lived in an apartment complex at some point in their life. And so there's just something about this product type that people can relate to. And so I found it really attractive. I think the market obviously is very strong, and we're in one of the best, if not the best, metro area in the country, fundamentally speaking. And so even when we had the last downturn, I mean, the market here was still far better than the rest of the country, and obviously it's really thriving like never before right now. So it's a great time to be in the multifamily field, and I see the arrow still trending upward.
Let me give you kind of an idea for everybody who's listening. Is residential real estate, whether you're selling single-family homes between, say, 1 and 4 doors, let's say there's 50,000 residential realtors in a large metropolitan area. And for Dallas, it would be from, say, Sherman all the way down to Hillsborough, and then from, say, Weatherford all the way out to Terrell or East Texas. So let's say there's 50,000 residential realtors. In the multifamily space, in that same general area, let's say that there's only 50 apartment brokers in that space. So 50,000 residential and 50 apartment brokers. And then we'll divide that in half by having the ones that do the A and B class properties. And then let's divide it another half by the ones that do the B and C class properties. Now, Nick does the A, B, and C, but he specializes in the B and C properties. And in this case, it's really the 80-20 rule, where there's only maybe about 20 or 25 brokers, and Nick is probably the top 1 or 2 or 3 brokers in all of Dallas and Fort Worth, and probably the number 1 or 2 or 3 brokers in all of the state of Texas. So when you define it, what you're really good at, Nick is a master on sales for multifamily properties. So, Mike, you had a question?
Yeah, I was going to see, how's your volume, or what's the differences in the market today than it was, say 10 years ago when you got started, 2004, and then how was the downturn in the economy affect volumes and kind of just your general experiences between the different cycles in the market?
I think first of all, I always like to be around Paul because he just makes me feel like really good about myself. So thank you for those kind words. But I think when I started in the business, as funny as it may seem, in 2004, e-blast didn't exist. That wasn't. I can remember people standing over a fax machine and literally typing 2,000 fax numbers in and then sending out a mass fax blast. So, I think the way that we're doing deals now is far more conducive to doing more volume and more transactions. I started off working on small deals, and then obviously, I entered the market at a really, really good time, and we got some traction instantly, and we really started collecting email addresses, and our business started growing, and we were trying to stay kind of on the forefront of where the technology was going. And so we started off kind of working on small deals, and then as the business grew, we started moving into that kind of 100+ unit space, and then obviously that's sort of, now we do deals of every shape and size. So as far as volume and that sort of thing, one other thing that has changed, which has really skewed these numbers and volume numbers, is sort of the evolution of the team structure in the multifamily industry. A lot of transactions 10 years ago were one guy, who was out there grinding and doing transactions. And so obviously if you've got one person doing all the work, there's only so much you can do. But when you've got 4 or 5 people all combining to attack a deal, you can do a lot more transactions. Since 2013, my team's done 54 deals, a little over 300 million in volume. That's about 7,800 units, a little over that. We've got a pretty good sized deal closing today that'll give us a little boost in that number as well. And more consistently closing one or two deals of pretty good size a month. So in the downturn, we were really fortunate. But what's sort of ironic is 2008 was at the time my best year ever. Oh, yeah. When a lot of people were kind of going the other way. You know, I was really kind of fortunate I had a big first quarter in that year, and then, you know, certainly could feel the same thing everyone else felt, which was the market slowing down and deals were harder to finance, and, you know, it was harder to find capital from out of state, and, you know, local guys didn't want to buy deals. So it was much more difficult, but we were really pretty fortunate that by then we had enough of a reputation and a brand in the market where we could still do more than our fair share of deals, even though it's certainly not nearly as many deals as we were doing before or are doing now, but we came through it okay. And I think the people that were able to buy during those years have really come through it okay. I mean, they, you know, when the downturn came and capital, you know, left the market, there were a lot of good deals that were bought, and now those folks look pretty smart. So, wow,
that's great. So, you know, I know this environment's pretty competitive, to put it mildly. So when you're out there listing property, and you obviously have done, you know, one or two in your day, it sounds like you're getting multiple offers on a deal. What sets apart me as a buyer versus my competitor? What makes you as a broker advise your client to choose one person over others? So kind of to recap some of the things that people can do to position themselves to make their offers more attractive and increase the likelihood of being accepted.
Yeah, I think that's a great question. I wish every buyer would ask us those questions on the front end. We like buyers who are very thorough on the front end. We like buyers who do what they say they're going to do. And, you know, certainly there are surprises in deals that, you know, you maybe couldn't foresee. But for people to come in and to do the obvious homework up front, if you think a parking lot doesn't look good, then, you know, bring a parking lot guy to drive by it and see it. You know what your budget is going to be up front, and be realistic. Have your financing kind of lined up, or have an idea of what you're going to do. Be able to demonstrate to the seller, like, here's where my equity is coming from, or here's what my track record is. Here's what I already know about the deal. Here's who's going to manage it. Here's my projected NOI. And by the way, I understand how property taxes work in Texas. And here's my assumption with respect to what's going to happen to the taxes. I think all those things sort of combined, they really help a seller feel comfortable with a buyer from a brokerage standpoint. So I've got one group that has done none of those things, and one who's laid out all the other specifics of how they plan to get the transaction done. You know, all things being equal, you know, it's not a hard decision for a seller, and certainly not a hard decision for us as to who to recommend. I think the thing I would certainly encourage all buyers to consider is just the reputation will follow you around in the business. And so you want the reputation to be someone who's going to close and who's going to do what they say they're going to do. And if you get that reputation, you're going to find that your track record's going to improve very quickly, because you're going to be somebody that brokers want to deal with. And every broker has clients that they've done a number of transactions with, and that's largely because of those factors.
Good. So that's great advice. So where do you see our market going here? I mean, we've obviously in the DFW area, I think nationally, really seen, you know, valuations substantially rise from the downturn here. Where's Nick Fluellen crystal ball looking forward? Can we sustain this? Are we topping out here? You know, what are the things that you see and that could affect it, you know, positively, negatively, and, you know, kind of your general take on the market and going forward?
I don't think we've topped out, and my guess is it's hard to look much further than 12 months down the road, and even 12 months down the road is a stretch. But there is no indication from an operations standpoint of the deals that I'm a part of and the deals that we are frequently underwriting. There's no indication of any sort of slowdown there in terms of activity in the market. There have been more deals, you know, launched in the last couple of months than even earlier this year when the market, you know, has taken off. So I don't think there's any sort of slowdown on the horizon. I've been conducting a number of owner surveys in preparation for a conference that Marcus and Millichap's getting ready to put on. And one of the questions on that survey is, you know, where do you see interest rates going? And it's interesting because the people that are answering that question are not lenders and they're not economists. They're people that are in the trenches that are actively buying and selling properties. And the consensus has been that interest rates will either increase a little or stay about the same. And that's obviously a huge factor in terms of our value. The DFW market and economy is very diverse. And we're not reliant on just the oil and gas industry or any one particular sector. We've had Toyota and State Farm, relocate their corporate headquarters. There's tons of infrastructure going up to support that. There's just so many people moving to the Dallas area that it's just hard to see any sort of major slowdown anytime in the near future. So I would anticipate 2015 is going to look a lot like 2014 and potentially even a little bit better if I had to predict.
So where do you see potential headwinds? If obviously you don't think it's coming, but where do you see the challenges potentially with the environment? Is it the lending drying up, or what was the biggest cause in 2008 that caused the most challenges for you guys closing deals in 2008, 2009?
Yeah, I think that's an interesting question, and certainly something that we kind of think about and talk about a lot internally. The most obvious answer would certainly be on the debt side. It was very difficult to get debt, attractive debt, in the last downturn. We had lenders that you could almost just kind of give them whatever underwriting you wanted them to use, and they would use it in the 04 through 07 type time frame. It was not hard to get a deal over the hump. Then obviously that sort of changed and went away for a while, and then now we've got lenders who are being more aggressive again, and Fannie and Freddie are very active. Obviously, should something change on the debt side, interest rates go up considerably, et cetera, that would have a material impact on the value. There's a lot of units under construction right now, but what's interesting is while that could be a negative, just with an oversupply problem potentially, I think what we're really seeing is that it's actually been more of a positive because we don't have an oversupply, and at the cost that to build these deals now, the rents they have to charge for them to make sense are astronomical, which just means that Class B assets rents have been able to be pushed very aggressively, which has trickled down certainly to the C space as well. And so historically, we may have had C deals that were trading for 25 and 30,000 a unit that are now trading for 40 to 45,000 a unit, and on up into the B space and the A space. There's just numbers that are being achieved right now that we've never seen. Historically speaking, that's nothing new. It's just a lot of the sales that happened prior were before my career started, and now I've just got a chance now to be a part of a couple of cycles, and so I can really see firsthand how inflation has kicked in, and we're seeing NOIs at crazy numbers and performance of properties like never before. So who knows? Maybe our economy, it's not going to keep going at this pace forever, but I think operating expenses could increase. I think payroll could increase. But I don't think they're going to increase at rates that are more rapid than what the revenues are increasing. And so if revenues started increasing at a rate that's less than what our operating expenses are increasing at, well, then, yeah, maybe we could have some problems. Obviously, the taxing authorities have gotten a lot more aggressive, and that's had a material impact on how people are underwriting deals. But again, they're not so much so that they offset all the gains that we've made on the revenue side.
And so when you're out there selling a property for, in the C space specifically or the B space, what are the things that current owners could do to their properties to make them more attractive on disposition? So what are the things that, everyone does the flooring and appliances and all those types of updates. What are some interesting new things you're seeing out in the marketplace that are kind of the leading edge of what's happening?
It's funny because the little things that you can do to maximize a property's value, a lot of them are not rocket science. They're not that hard to implement even. As an example, property that we have in Irving, right now is we had residents, the way it's laid out, who wanted to park closer to their unit. And so our manager said, I'm sure I can do reserved parking, not covered parking, reserved parking, literally a can of paint, painting some numbers on a parking spot. We have 60 spaces available, and she leased all 60 at $25 a pop immediately. Within 40 days, they were all gone. Yeah. Well, you start taking, $25 a month times 60 spaces times 12 months and cap that at an 8.5 cap or a 7.5 cap or whatever the number is. And you literally have hundreds of thousands of dollars in value created as a result of a can of paint and a little extra effort by your manager. So, that'd be one example. I think some of these residents and the little amenities like playgrounds and some of the community amenities, just a nice swimming pool, certainly, the space around swimming pools has been made nicer with some of the little outdoor kitchen areas and the pergola, and picnic areas that, are a little more grand than they used to be. It used to be, I'm just going to throw a grill in here and a little table and, we'll call that a community grill. I mean, I think just something with a little more intentionality, I think it's really good for retention and it's a community builder. Probably the lowest hanging fruit is water conservation. It's not even something that you do in-house, and it's something you can get not only an immediate payback for dollar, but on a capitalized basis, it's incredible. There's a property that had a water bill that was, about $140,000. Did the water conservation. I think it cost them $52,000 to go in, put all new toilets, new aerators, in the faucets in the kitchen and bathroom and shower. And that water bill went from $140,000 to $75,000 in 12 months.
Wow. And
so again, not only did you get a dollar for dollar savings, but again, you take that $65,000 and capitalize it at a 10 cap, that's $650,000 in value. And it's certainly a lot more than that. So there are the very easy, simple, logical things that you can do without having to try to be super creative and try to reinvent the wheel that are just really invaluable ways to add to the bottom line.
That's correct.
That probably makes a good transition to talk about your apartment ownership and your experience. Again, Nick is a little bit unusual, is that not only does he sell apartment buildings, but he also owns apartment buildings. And not a lot of people who sell apartment buildings actually own apartment buildings, so they don't have an in-depth knowledge of expenses. And that's probably the key thing that I see is what expense structure are. A lot of people think that they can look through a book and kind of give a wag of what expenses are, but Nick actually owns apartment buildings, so he can give us up-to-date information when he is selling a property of what actually are real numbers on the property. Let's kind of talk a little bit about what you own, just to give people a perspective. You own a property down in College Station, your alma mater area. So tell us a little bit about that one.
The College Station market is obviously an area that I lived in for 6 years through undergrad and grad school. And in 2008, had a chance to buy a deal that was on the market down there. And that deal was 82 units. So we bought that original deal in February of 08. And, the goal of it really was, we weren't trying to hit a home run with the deal, but it was, hey, it's a great safe place to put your money, and we can find a place where we can get nice double-digit return and, eventually let inflation kick in and pay the principal down and get some appreciation. That sounded like a win. Well, then 12 months later, there was a property right next door, literally adjacent to the property, that was 44 units, and the owners had decided they wanted to sell that deal. And so we were obviously a logical buyer, the same kind of partnership that owned the first 82 units. And so we put that deal under contract. And then there was an 18-unit deal across the street. And so we thought, well, if we're going to increase our scale, let's reach out to them and see if they're interested. And they were. And so we ended up closing the 18-unit and the 44-unit simultaneously, two separate sellers, and then combining the operations all into one deal, and then ended up taking out those lenders and putting one Fannie Mae loan on the entire property and changing the name and rebranding it, about a year, 2 years later. So that was sort of the first experience. We still have that deal right now. Probably we exit that deal in sometime in 2015, but it's been a good, steady deal, and we've certainly learned a lot from owning and operating that asset.
Now, College Station, that's in a college town. Is that student housing down there?
It's a little further south of campus. We have some students. It's not a student-driven community, and we're on the shuttle route to campus. There's not a lot of properties that are really close to campus there, so that's kind of the mark of being a student property. You need to be on the shuttle route, but we've never branded ourselves that way, and it's really more for the working class, and blue collar and even some white collar and grad student type folks down there is kind of who our tenants have typically been.
Let's talk about deal number 2. And that's a property called Vista up in Plano. Tell us a little bit about how big that deal is and tell us a little bit about that property.
I think after the College Station experience, that kind of came in, 2008, 2009. We operated that for a number of years. Like anything, the market's changed. The trends in multifamily have changed. We had a client of mine who was very interested in Vista, and we just decided let's partner up and put a partnership together and buy that deal. And different sort of partnership structure, different sort of objectives. A lot of investors look, strictly at, hey, what am I making going into the deal? What's my cash on cash return? We didn't really look at it that way. We look at it more from how much value can we create. And Amber Vista's in Plano. It's a very, it's on a hard corner, high traffic street, and had really good bones and a lot of really attractive attributes. It had a new roof, had a lot of new HVACs. Almost all of them were new, but the interiors were really pretty basic. And so that was kind of the thinking there, is we can go in and improve on what's already been done very well out there and really push rents quite a bit. And we've certainly been able to do that.
And I think that was probably one of the things that I thought was interesting about that deal, is that you started to have a track record of ownership. An investor wanted you to partner up with them because he recognized you had ownership in transactions. That may be something for our audience to kind of think about too, is that partner up with the possible listing agent if the investment makes sense, that you guys can form a little team to take down a property.
I do sort of bring in a different perspective than maybe some other people to the table, just because I have so many conversations from potential buyers literally every day about how they're looking at deals and what do they want out of a deal and what do they like about a deal and what do they not like about a deal. And so, yeah, I think it is kind of a unique advantage that we have. I mean, I'm not super involved on the management side. We let our management company do their thing, but we certainly, on a macro level, as far as what overall direction we want to go with the property and, what our primary objectives are, we're real clear on those things, and then we leave it up to them to execute. But there's definitely a lot of intentionality with how we approach, our operations, and it's real clear from the people sitting behind the desk doing the work every day what the ultimate goal is. And
let's talk about another success in your portfolio, that Villa France. Tell us a little bit about that one. How many units was that?
Villa France is 134 units. And this is a prime example of a property that has, you can see the changes in the market, when you look at this deal. This deal was doing very well when we bought it, well enough that we were able to put a Fannie Mae loan on it, at the time of acquisition. So it underwrote very clean, great loan, great interest rate, 80% LTV.
Remember what your cash coming into that property and rents was?
The revenue at the time of acquisition was, in the upper 80,000s a month. It had been trending up, but it kind of stabilized in that 88, 89, thousand. I think they touched 90 one month and then kind of stabilized back down into that upper 80s range.
And with Nick overseeing the property management company, that was really the eyes and ears for Nick on the property. They were able to push rents to, where's the thing?
We spent about $300,000 on the deal, just kind of freshening it up, adding some amenities, and really sprucing up the interiors. And, in the last month, we collected $108,000. So we literally have had a $20,000 a month increase, and we're talking over a 15-month period of time. This isn't over 5 years. These rents and this revenue that we're achieving is exceeding our year 5 projections. And so I think we've certainly done some things right. The on-site manager deserves far more of the credit than anyone else does. You're obviously as good as your on-site manager is and leasing agent, and they are spectacular. But it's extremely rare and unusual to see that type of growth in the marketplace. But I think it's indicative of, if you give residents a place that they can be proud of, whether it's a Class C property or whatever type of property it is, they'll pay for it. And our rents are considerably higher than what we were getting at the time, and we also are now charging back for the reserved parking, on that property and some of the other areas that we've maximized the revenue. And so it's just been an absolute grand slam when you really think about that kind of NOI growth.
I think one of the things might be kind of helpful for everybody is you may talk about some of the challenges along the way, either maybe through the brokerage side and, for either one of your clients, maybe a particularly hard, challenging thing. I know in the Villa France deal, right at the 11th hour, you had a little financing issue that Paul was able to help you through. But if you have any examples of any challenges or any lessons you learned off of along the way that you can share with everybody that was particularly useful you take with you going forward when you're doing deals?
Absolutely. I think one thing that we consistently see, and we're seeing it a little less now because I think people have wised up in a lot of ways. But the biggest mistake, and we were certainly guilty of this in College Station, is undercapitalizing the deal on the front end. In order to get the kind of growth, if you want to grow your NOI by a couple $100,000, make sure you've got the money in the deal structure to be able to push rents and to put money into the interiors. It's a huge mistake to think you're going to fund your interior improvements out of the cash flow. It sounds great in principle. I'm not saying that you can't do a little bit of that, but if you want to get big gains, you got to have the money up front to do it. Otherwise, a lot of things just never get done. And so I would say get good, real numbers, build yourself a little buffer because there's always surprises. When it's all said and done, again, you give people what they want, they will pay for it. And especially in the market right now where rents have been raised so aggressively across the board. And it's a huge mistake to be undercapitalized. And then I think, just challenges come up in every deal. And so just be committed to getting the deal done. And you always have to be thinking about your contingency plan pretty much in every scenario of the deal. What happens if this lender bails out, or what happens if I lose an equity partner, or any sort of challenge that can come up. You should probably be thinking about it, because one thing we know, there's very few certainties in a deal, but one of the certainties is that there will be some sort of problem that comes up from the time you sign that contract till the time that you get to the finish line. So how you deal with that is just really important.
And that's one of the issues that you had with Villa France, is that you guys had locked the loan, everything was ready to go, and then you had one of your equity partners back out of the deal for some bizarre reason, but they just weren't going to be in to help you in the deal.
His attorney did not like some of the language in the Fannie Mae documents, and you're not going to get Fannie Mae to change that language. And they've done a couple of loans for the last few years, and so that sort of is what it is. Again, you learn from every one of these deals. We didn't even think of that possibility of that being a problem. Anything out of the ordinary, but it was.
We got a solution.
But we found a solution.
A great solution that really became a great partner with you, and that everything's worked out well. And that partner couldn't thank that old equity partner enough on helping him get that position that he didn't have before. So that really worked out well. I
think it's worked out okay for everyone who was in the deal. And to your point, as far as working out a solution, I think we're in an environment where people want to sometimes undervalue a relationship and what that relationship really means to you. And if you're just choosing a mortgage broker or a lender or any of your vendors in a transaction because they're the cheapest, or they'll give you a little bit of a break in this fee or this expense, you're really making a mistake. Or you certainly could be making a deal killing mistake. And having Old Capital kind of working with us hand in hand to try to make sure we could get over the hump at that 11th hour, was a huge value, for us in that transaction. And so we're very appreciative. We do a lot of business with Old Capital. We love working with you guys, but I do think that's just really important. Same, talking even earlier about the mistakes you make, and I will. Disclaimer, I do not own a management company or have any involvement in a management company, but people that beat their management company up for a little bit of a discount on the management fee, that's the last person I want to disincentivize to be happy. I want them to be excited about my properties. And so I would just think about what you're really trying to accomplish. And if this little nominal amount of dollars that you're saving in whatever facet of the transaction it is really worth jeopardizing kind of what your end goal is.
That's great. Well, Nick, I appreciate your time. What's the best way if someone wants to reach out and contact you? What's the best way to reach you?
My website is www.multifamilyadvisors.com, or you can reach me directly in my office at 972-755-5214, and would certainly welcome the opportunity to talk with anyone, and whether it's specifically about a deal or just some area that I could help in. We always welcome that on my team. Just kind of co-strategizing and sort of taking the partnership approach, with our clients and helping in any way we can. And we know at some point that'll come back around and in a deal or in some way, shape, or form, but we're more concerned about building good relationships and helping people kind of achieve the goals that they're trying to achieve. So love the opportunity.
Well, Nick, thank you so much for your time, and we'll talk to you soon.
Thank you, guys.
Hey, Paul, I really thought that was a great interview. Nick is really one of the most preeminent multifamily brokers in the state of Texas. And, he probably sells as many apartment units as anybody, probably in the entire nation. I could really tell that he's got his finger on the pulse of what's going on in the marketplace today and what it really takes to operate an apartment complex.
Mike, what I got out of that podcast, our simple conversation was incentivizing the right people. The management company can make you or break you. So put the dollars to the people that can make you a lot more money. So I liked his comments on management.
Yeah, that's really sage advice. So we just really want to thank everyone for listening to today's Old Capital Real Estate Investing podcast. If you want to find out more information about us, please visit us at oldcapitallending.com. You can find our contact information on the website. Also, if you like what you hear, if you would please go to iTunes and give us a good rating, a 5-star rating, and a nice review. That would really help us get our message out to everybody else. Thank you. I'll see you guys next week on the Old Capital Real Estate Investing podcast.
Thank you for listening to the Old Capital Real Estate Investing podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.